Should you take out money in the form of salary or dividend from your company? Today, we will first talk about the pros and cons of the two. Then I'll walk you through a couple of examples. Then I will tell you what you should think about before making the final decision. And in the end, talk about some points for you to consider going forward. Let's get started with salary first. The advantages with salary are that the amount declared as salary is deductible to the corporation, thus reducing the taxable income. You're able to contribute into your RRSP with a salary. There is an opportunity to splitting income with other family members who are employees of the company to reduce the overall tax liability, and you're eligible for full CPP benefits after retirement. The disadvantages with salary are that it is taxed at a higher rate than dividend. You have to pay into CPP, so you have to pay the employee and the employer portion, so your cash flow takes a little hit. Lastly, there's admin time spent on payroll and issuing T4s as required by the CRA. Now, the advantages with dividend are that there are three types of dividend: non-eligible, eligible, and capital dividends. I will do a separate video on these three types of dividends. Then there is an opportunity to split income with other shareholders. Dividends are taxed at a lower rate than salary. You don't need to make any CPP deductions or remittances. And you can pay yourself a dividend just by writing a check. It's as simple as that. The disadvantage with dividends are that they are not deductible to the corporation. They are paid from the after-tax profits of the corporation. You don't get any room for RRSP contribution. You're not able to claim certain tax deductions and credits, like the childcare expenses or the employment tax credit. And you need to spend time updating corporate minute books and preparing director's resolution. Now, let's walk you through our first example. We have two guys, Michael and Chris. Both are small business owners of the companies with same earnings, but Michael will take out a salary whereas Chris will take out dividends. We are assuming both companies earn an active business income and are eligible for small business deduction of 15% federally and provincially in Ontario, and Chris is taking out a non-eligible dividend. In the case of Michael, his company makes a profit before tax of $100,000 and he pays himself a salary of $100,000, which brings the company's taxable income to zero. On the $100,000, Michael will have personal tax liability of $25,197. On top of that, there will be an employee portion and an employer portion of CPP for $2,544 each, which brings the total tax liability to $30,285. On the other hand, Chris's company also makes a profit before tax of $100,000. Remember, the dividends are paid from after-tax profit of the corporation. So the tax on the profit will be $15,000, which brings after-tax profit to $85,000. On the $85,000 dividends, Chris's personal tax would be $10,988. When you add the corporate tax and the personal tax, the total tax liability comes to $25,988. As you can see, paying dividends lowers the overall tax liability. Now let's take a look at another example with the same assumptions, but this time profits before tax are $500,000 for both corporations. Under this scenario, as you can see, Michael will have a total tax liability of $236,690, whereas Chris's total tax liability will be $232,254. Again, paying dividend is still a better choice. Now, you should ask yourself these questions before making a final decision. What is your personal financial situation? What is your income level? What are your cash flow needs? What is your corporation's expected income for the year? Do you have RSP room available? Are other personal deductions important to you, like childcare expenses? Your age? Now, is your company making more than $500,000 in profit? Usually, it's better to pay salary to reduce the corporate taxable income to $500,000, so you are within the small business deduction limit. Is CPP important to you? If it is, consider paying yourself a salary up to the maximum CPP limit. Or consider paying salary up to the maximum RRSP limit if RRSP is important to you. Remember, there are three types of dividends: non-eligible, eligible, and capital dividend. And in the end, here are some things I want to point out for you guys to consider going forward. Do you have children over the age of 18? If you do, you should consider setting up a family trust and make that the shareholder of the operating corporation. The trust can pay dividends to the children. This way, your child pays no or very little tax because of dividend tax credits and personal exemption. This is a great way to pass on income to your kids without increasing your own income, and a good strategy to put your kids through university and college. I hope you guys found this video helpful, and if you have any questions, please feel free to post them in the comment section below. I am a CPA CA with a passion to help small and medium-sized business owners and entrepreneurs in Canada. So please feel free to reach out to me.